Welcome to your ultimate pit stop, Piston Pundit. The EV revolution is turning against itself. Not too long ago, the world was bracing for a new era dominated by Chinese EV makers with their cutting-edge technology and unbeatable prices. But as it turns out, that takeover might never happen. The Chinese market is faltering, and we've identified 8 key signs that suggest the Chinese EV market might be on the brink of collapse. Let's dive into the details. Number 8. Post-pandemic economic struggles. COVID-19 hit the Chinese economy hard, and recovery is still underway. After decades of rapid growth, the economy has peaked, with projected growth for this year at just 4%. Challenges include an aging population and a faltering banking system. The government is trying to inject liquidity and stimulate spending, but the middle class is struggling, evident in the near collapse of the real estate market. The automotive market, including EVs, is also stagnating. In 2017, China saw 24 million new vehicle registrations, but last year it dropped to just over 21 million. With a sluggish economy and declining domestic growth, Chinese EV makers face significant hurdles, both at home and abroad. The future outlook remains uncertain as they navigate these turbulent times. Number 7. The domestic market stagnation. Growth has slowed across global markets, including China. After a year of impressive gains, the growth rate has sharply decreased. In 2022, the EV market saw a remarkable 96% year-over-year increase, but this dropped to 33% in 2023 and is expected to slow further to under 22% this year. While this might seem strong under normal circumstances, it falls short of the high expectations set by EV makers. Initial excitement has faded, with customers increasingly sticking to traditional internal combustion engine vehicles. The decline in enthusiasm and the end of the early adopter phase are hitting the EV sector hard. As a result, the market is struggling to sustain its previous momentum, setting the stage for the next major challenge. Number 6. Tesla's struggles in China. Tesla, while not a Chinese EV maker, operates extensively in China and reflects the challenges facing the industry. As a global leader in EVs, Tesla is feeling the strain as selling EVs becomes increasingly difficult. Once a dominant force in China, Tesla's sales have plummeted. Last quarter, it sold around 300,000 vehicles, a significant drop from over 400,000 in late 2023, marking a 43% decline. Tesla now holds just 10% of the Chinese EV market, trailing behind BYD's 33% share. In response, Tesla has slashed prices to stay competitive. The Model 3 is now about $6,000 cheaper at $31,000, and the Model Y starts at $35,700, down from over $40,000. To cut costs, Tesla is reducing its global workforce by 14,500, with a significant portion likely from China. Before we delve deeper, do us a favor and smash that like and subscribe button. This helps us reach more auto enthusiasts just like you. Now let's shift gears and steer towards our next point. Number 5. The knockout phase begins. With sluggish EV demand and a saturated market, many Chinese EV makers face a grim future. The industry is overcrowded with nearly 100 registered companies, but most won't survive. The once rapid growth has slowed, creating an imbalance between supply and demand, exacerbated by a fierce price war. Many smaller EV makers, heavily reliant on government support and struggling with profitability, are at risk. Zhang Xiang from Huanghe Science and Technology University predicts that the market will shed most small-scale manufacturers, with only 25 to 30 companies likely to survive by decade's end, according to Alex Partners. Currently, the top 10 EV makers dominate 80% of the market, while a third of companies sell fewer than 500 vehicles per quarter. As some major startups declare bankruptcy, the industry's consolidation is imminent. Number 4. The price war's toll. Car makers based their strategies on years of rapid growth, but with demand cooling and production soaring, they're now in a tight spot. China's market, saturated with nearly 100 EV makers, leaves little room to stand out, so price cuts have become a common strategy. While these cuts, averaging 30% off recent prices, might seem beneficial, they've led to frustration among early buyers. Many who purchased EVs before the price drops feel betrayed, especially since discounts can exceed $5,000. This has even sparked small protests from those feeling duped. Consequently, many potential buyers are hesitant, preferring to stick with their current vehicles to avoid future regrets and potential dissatisfaction with new EVs. Number 3. Collaborations for survival. The oversupply in the EV market and the ongoing price war are likely to persist, leading to the closure of many companies in the coming years due to financial instability. With the Chinese economy struggling and investors losing interest in the sector, securing new capital is increasingly challenging. Small and medium-sized companies are left with two main options: seek new investors or form strategic alliances. Even major players are forming partnerships, such as Geely's recent alliance with smartphone maker Meizu to launch the Meizu Dream Car MX. Similarly, Huawei has partnered with Chery to introduce the Luxeed S7, aimed at competing with the Tesla Model S. These collaborations provide necessary capital and resources, and for many EV startups and established car makers, this approach is becoming essential for survival. Number 2. Challenges in global expansion. China's EV market faces significant challenges, and expanding internationally adds complexity. Despite early optimism, 2024 has highlighted that entering Western markets like the US and Europe is tougher than expected. Protectionist policies are a major barrier. The US Inflation Reduction Act favors domestic EV production, while Europe's regulations on environmental standards and local content challenge Chinese EVs. Additionally, cultural and brand perception issues persist, with skepticism about the quality and safety of Chinese vehicles, further strained by geopolitical tensions. Logistical and distribution hurdles also complicate international expansion. With razor-thin margins from domestic price wars, many Chinese EV makers find global success elusive, leaving their international prospects uncertain. Number 1. Technological challenges ahead. China's EV industry has advanced in battery technology and vehicle design, but 2024 has exposed several critical challenges. A major issue is the shortage of high-quality lithium, essential for EV batteries, which has caused production delays and cost increases. Additionally, efforts to develop advanced technologies like solid-state batteries face hurdles. Companies such as CATL and BYD struggle to scale these innovations for mass production, raising concerns about meeting future demand and losing a competitive edge to European and North American rivals. Quality issues with EV software, including glitches in advanced driver assistance systems, ADAS, have led to recalls and diminished consumer confidence. These technological challenges threaten China's leadership in the global EV market, urging manufacturers to innovate rapidly or risk falling behind. Thanks for watching. If you enjoyed this video, don't forget to subscribe to Piston Pundit for the latest updates and more insights into the world of vehicles. Also, please share your thoughts and experiences in the comments below. See you next time.